So today we're talking about tax terms, which I know is everybody's favorite subject. Yeah, I was telling people around the office today we're going to talk about this, and I think some of them actually fell asleep. It's both boring and daunting and can kind of scare people. So today we're just taking, a large 20,000 foot view of some basic tax terms, and we'll kind of run through a little scenario of how it applies to people. Let's say you're a doctor. You make $100,000 a year. It's February of next year, and you've got to start getting your tax docs together. First thing you need to gather is everything that's going to tell the IRS how much gross income you had for the year. One, you might have something called a W-2. If you're an employee, let's say you're the doctor and you're an employee at a hospital, you would have a W-2 income. Now let's say you're also doing some doctor consulting on the side. You've got a private practice or you do just some at-home visits or something. You might have what's called 1099 income. This is income, you're not an employee, you kind of run your own business, taxes aren't being withheld, so you need to let the government know that, okay, well, I made this much income over here that hasn't been taxed yet. So those are the two big documents you need to get a hold of, all your W-2s and all your 1099s. There's other things out there. You might have some investment income. There's a form called 1099 DIV, 1099 DIV. That's any distributions or dividends you got from investment accounts that aren't qualified accounts. Qualified accounts are your IRAs, your 401ks, your 403bs. So again, lots of fun terms in this video. But once you get all your income from investment accounts, from your W-2s, from your 1099s, then you're going to have your gross income. Now, from your gross income, you're going to have adjustments. So again, $100,000 a year, adjustments. I put $5,000 into an IRA. That gives you adjusted gross income of $95,000. So you're going to hear terms like above the line, below the line. Above the line is just gross income minus adjustments gives you your adjusted gross income. And then below the line or after that are your deductions. They're your standard deduction or your itemized deductions. It could be an itemized deduction, mortgage interest, charitable donations. There's many things you can take away. Or if you don't, it's something called the standard deduction, which is the government allows you to take a flat amount. Married filing jointly, I think it's about $25,000. It's somewhere around there. And then if individual, it's like $12,500. So you can take that off your income as well. So again, for easy math, if you have $100,000 of gross income, no adjustments, so $100,000 adjusted gross income, you might be able to take out $12,500 or $25,000 off that, showing $75,000 income that year. So again, gross income minus adjustments gives you adjusted gross income, minus deductions gives you your taxable income. And from taxable income, then you find out which tax bracket you're in. Something that people don't understand sometimes is that it is a progressive income tax. That's what we have in this country. So if you're single and you make $100,000, I believe that drops you into the 22% tax bracket. So people think that, okay, all my income is going to be at 22%. That's not true. From zero to the first $11,600, you pay 10% tax on that money. So if you make $10,000, 10% tax on that, you're going to pay $1,000 in taxes. From $11,600 to $47,000, you're in the 12% tax bracket. So only that money over $11,600 gets taxed at 12%. The whole amount of money you make doesn't get taxed at 12%, just that amount over $11,600. When talking to people, some people worry about making extra money and then they think they're going to fall into the next bracket that taxes all their income at a higher level. That's not true. It's just the next bracket you get into, only that extra amount gets taxed at the higher income bracket. Again, let's do an example of somebody who makes $100,000, how much they're going to pay. They are single, filing singly. From $0 to $11,600, you're paying $1,160, 10% bracket. From $11,600 to $47,150, you're in the 12% bracket. And then from the $47,150 to $100,000, you're in the 22% bracket and you're paying $11,627. So you can see that even though you're in the 22% bracket, it's not 22% of all your income. It's just on that portion that's above $47,150. So that's the way to understand progressive tax brackets. And then from your taxable income, you have something called tax credits. Tax credit is different from a tax deduction. Tax credit doesn't come off your income, it actually reduces your amount of taxes. So again, just for easy number examples, you made $100,000, you put $5,000 in IRA, shows you at $95,000 of income for the year. The 10% bracket, that means you owe $9,500 for taxes that year. A tax credit, there's, for example, the child tax credit, there's a dependent care credit if you have child care. So if the child tax credit's $2,000, that means that $9,500, you can take $2,000 off of that to $7,500 of taxes owed. So deductions are great because they lower your amount of income you have. But the credits are awesome because they actually lower the taxable amount. Those are some of the key tax terms. I know I've gone quickly through a lot of them, but you start off with your gross income, adjustments, adjusted gross income, deductions. From deductions, you get your taxable income. From taxable income, you can take off your credits, and that gives you your taxable base right there. Find out which tax bracket you're in, and then go from there. Now, when you get your 1099 div, as I mentioned before, 1099 DIV, that just means has there been any distributions or dividends from your investment account. Two big categories are qualified and non-qualified. Qualified means tax qualified, so your IRAs, your 401ks, anything where you can get a deduction from, they're qualified for deductions. Non-qualified means just regular investment account. For an example, if you have $1,000 in just a regular non-qualified investment account, you make a 10% return, that's $1,100 you have now. As long as you don't take any money out, you don't owe any taxes. But let's say you pulled out that $100. If you waited 1 year and 1 day, you pay long-term capital gains on that $100. So, which is 15% for most tax brackets. Could get up to 20 if you have a higher income bracket, but we'll use 15 as the example. So you had $1,000, you made 100, you pulled 100 out, you pay long-term capital gains on $100, 15%. If you pulled it out before a year and a day, it gets added to your income as ordinary income, as they say. So, example before, if you made $100,000 and you pulled out that $100 of gains from an investment account before 1 year is up, then you're going to show $100,100 of income that year. There are ways to reduce capital gains and capital losses on your taxes. I would suggest talking to a financial advisor. We here at Virginia Asset Management would be happy to talk to you, but honestly, just talk to somebody about that. There's a lot that can go into reducing the taxable liability for every year.